we thought it might be quite interesting to talk a bit about inflation and how it might impact on portfolio investment going forward from here. In the next slide, we've kind of split this down into 4 parts, how inflationary pressures might dominate the financial landscape in the coming this year and in the next couple of years. And first of all, it's worth mentioning the pandemic. So in the next slide, you'll see within the cases and vaccines issue, this is probably the most difficult issue to address, because we've seen different waves, and we're still in the 4th wave, the Delta variant. But certainly within the developed world, we've seen the death rates go down, and definitely economies beginning to open up again. And as these economies have opened up, of course, some of the issues that we're seeing are the supply disruption in getting product and services around the world. There's lots of pent-up demand, but in various industries, and we'll talk about them later on, they're really struggling to restart in certain areas. And this has been hindered further by renewed lockdowns in certain countries. If you look at something like Malaysia, where a lot of semiconductor testing goes on, just last month it had to lock down for another couple of weeks because of a resurgence in the pandemic. So the pandemic is probably the most difficult part to gauge at the moment, but it's not going away, so it will be an issue. On the next slide, though, it is encouraging that we're seeing the rollout of vaccines, particularly through the emerging world. The developed world is well down the road of vaccinations, as we know. We're all coming up to getting our boosters soon, and flu, and that will probably just continue. But within the emerging world, it's probably about a year and a half behind the developed world, and that therefore things like Asia are probably more of a next year's story in terms of production and dividends and earnings increases. So we'll just have to see how this goes, but it looks as if we're making progress in terms of the pandemic. Now, in terms of issue 2, which is the next slide, is just how concerning is inflation for the developed world and also for the emerging world. And this is where we begin to get into the crux of the issue here. I mentioned at the beginning, transient or intransient. There is a common thread that's going through from policymakers and politicians at the moment, that they're saying that inflation is transitory. This is on issue 2, the next slide. But what there is no evidence at the moment that is purely transitory. That is more just like wishful thinking, actually. So we have to look at inflation. If we could have the next slide, please, Antonia, thanks. If we look at inflation, we have to look at it in a more objective way than just wishful thinking and hoping that prices will decline at some point in time. Because what we've seen is enormous increases in commodities, in particular things like wood, glass, aluminium, and all sorts of soft commodities as well. Bottlenecks, logistical issues, yes, they're definitely there, but that only is actually telling one part of the problem, the price side of it. What we're more interested from an investment point of view is the overall effect of inflation on profitability. And here we have to look at unit labor costs, because unit labor costs are going to be absolutely vital here. When unit labor costs are rising, if output rises at the same time, then it doesn't really have any impact on the cost of production, and it won't have an impact on margins. But what happens when unit labor costs rise and productivity doesn't increase, then it either begins to eat the margin, or the company has to try and pass it through. So it is becoming more evident, and we're hearing it from companies in trading statements, that wages are rising. And remember, wages are much more sticky. When they go up, it's very difficult for them to come down. And this is something that will have big implications for certain sectors of the economy and of investment portfolios that, again, we'll talk about later on. On the next slide, the legacy effect from the pandemic will probably be on growth. And this is a combination here of, if you like to think about it in terms of the inflationary impact of what we're going through at the moment, but also the debt impact of what we've been through. And it is very important. We've just got a European example here, where you can see that up to the global financial crash, the sort of average growth rate of Europe was 2.5%. And it's similar in the UK, where the growth rate was about 2.6, 2.7. After the global financial crisis, with all the debt that was issued, the long-term growth rate declined in Europe to about 1.8. And with this pandemic, you'll probably find that the long-term growth rate declines even further. And that's a combination of additional debt servicing, but also as inflation bites in things like energy and things like rent or mortgage payments, and of course food, then the amount of money left for discretionary spending contracts, and therefore you do suffer growth. And this is before we even start to talk about interest rates. So looking forward from here, in terms of the UK, in terms of Europe, probably the US as well, the lasting effect on growth from the pandemic will probably be to reduce these growth rates further. Whereas in things like Asia and emerging markets, this effect is not so pronounced. So we will continue to expect better growth in these regions. How inflation impacts on it as well will depend whether it's stubborn within prices or whether it goes into the labour market as well, which I want to make reference to in a minute. On the next slide, in issue 3, is the issue of interest rates, and something that obviously the market is obsessed with. First of all, when we focus on the developed world, we know that nobody's really moved on rates yet. And the question will be, does it actually really matter whether they move on rates? The problem with inflation is that the longer the CPI, the retail price index stays about 5%, then the more pressure that builds for policymakers to raise rates. And of course, the issue with raising rates is what it does to dampen growth, and profitability, and perhaps more importantly for equity markets that are high and very expensive, what it actually does for the multiple, because it can then start to compress the multiple of very highly rated stocks. The interesting thing about this chart is that, yes, we've seen no movement on rates in the UK or the US or Europe, but you can see in the emerging world, they're already well ahead of the curve. They want to re-establish real interest rates in those markets as quickly as possible. So you can see there's been quite a lot of tightening in various emerging market countries already, in anticipation that the inflation isn't transient or transitory, and it may linger around for a bit longer than people think. So this is some insurance being built in here. How can they do this? Well, on the next slide, you'll see on page 4, issue 3, the sovereign risk in the emerging markets, such as Asia and many emerging markets, is actually much lower than the sovereign risk in developed markets, for the simple reason they're far less leveraged. Now, this is partly a legacy from the global financial crisis, where the developed world printed so much money that most of the sovereigns became extremely leveraged. But there's much more fiscal rectitude in the emerging market world, and therefore they're in a much stronger position to actually raise rates, as they've been doing, ahead of inflation than the developed world is. And the developed world is really in a bit of a catch-22 position here. Now, on issue 4, it's the issue of bond yields, and something, sorry, the slide just before that's it, Antonio. The issue that preoccupies so many people's mind is what happens to bond yields, because for 40 years we've been in a declining yield environment, a bull market for bonds. For 40 years, people have predicted that these would reverse, and they haven't. The issue now is there some fundamental difference in the inflation outlook that will mean that bond yields will rise? And the evidence, not the wishful thinking, but the evidence suggests at the moment that there is. And that the reason is that as inflation goes into the labour market, then this will become more stubborn and more persistent. Now, why should it go into the labour market? Well, it's very interesting that when the pandemic happened, it was very, very beneficial to capital-intensive industries. And labour-intensive industries basically shut down during the pandemic, and lots of labour was shed. So productivity was very strong last year. Capital-intensive business, particularly in technology, and indeed even some in the gig economy, performed very well. But because policymakers are focusing on getting unemployment down and employment up, then that process has actually gone into reverse. So employment growth is now outstripping output growth in most of the developed world. And as that happens, wages are rising. And wages are rising because prices have risen to the point where you can't negotiate a wage rise for the next 12 months of 1% if you know the retail price index is 5. It just doesn't happen. And for those of us who have been around even longer, we know from the Phillips curve that what gets built into wages going forward from here is expectations of inflation, which becomes even more powerful driver. And therefore, if the retail price index is 5 today, might it be 6 next year, etc. So whilst we fully accept that some of the pricing pressure on commodities and on the supply chain bottlenecks and things that have happened may come out sometime next year as the economies start to work a bit better, and there's more liberalization in some of the supply economies in Asia, for example, then yes, we could see some price inflation in commodities and goods and services begin to decline. But there is increasing evidence that this inflation is going to get into the labour market as policymakers focus on getting employment down. And remember, there will be no austerity following the pandemic, because this is not like the global financial crisis. This was nobody's fault. So you can't expect the ordinary person to pay for this. It's been paid for by printing money from a fiscal point of view. So we wouldn't be, it wouldn't be unreasonable to expect that bond yields will rise sometimes from here. Whether short rates go up or not depends on whether policymakers hold their nerve or not. But remember, most of big ticket items such as cars, houses, lots of consumption is priced off the 10-year or the 20-year bond, the long end of the bond market. So that in itself could have a slowing effect on parts of the developed world. And in the next slide, excuse me, from an investment point of view, this is very, very interesting in as much as people talk about value and growth over a long period of time. You don't invest in value per se in terms of bombed out value. We're talking about companies really here that have just been ignored because markets have become narrower and narrower and narrower, particularly in the United States, where 5 stocks account for about 24% of the S&P 500. And as more of these companies have been left behind, the valuations on some of these businesses, particularly in Asia, looks extremely compelling now because they have the operational leverage coming out of the pandemic as social mobility starts to increase. And you can see from the next slide that it's even more pronounced, where so many economies and companies are benefiting from coming out in terms of global trade and the way it started to go up. But in terms of stock prices in certain areas of the world, being totally ignored because of passive flows and because of the concentration in markets going forward from here. So from our point of view, from a portfolio point of view, you can look at inflation really in sort of 3 ways. If you have a capital intensive business, and for us that would be something like Atlas Copco or Epiroc, which are industrials in Sweden, or Han High Precision perhaps in Taiwan, a capital intensive business that has a product that is maybe not a big ticket item, but basically buys in manufacture goods, assembles them and then sells them, is relatively straightforward to pass through the price. You can usually add a bit more price, and therefore in the absence of any labor intensity, your margin will be either protected or may even go up as volumes increase, because you don't have the pressure on wages. For purely labor intensive businesses, particularly in some consumer discretionary areas, this could be a real problem, because it's very difficult to pass through increasing wages in various businesses when there is a huge competition for the discretionary pound. And you see that in all sorts of business models that have emerged over the last 2 or 3 years, when it's been relatively straightforward to operate them because wages were never under any pressure to go up. But it remains to be seen how they cope with upward pressure on wages in that type of business. And cost sensitivity in certain businesses, we'll just have to wait and see how it impacts the likes of things like Unilever or PepsiCo, because yes, their costs are rising, and yes, they are in very competitive consumer good type businesses, but the distribution networks are such that they may be able to push through the prices on certain goods and in other businesses, services, but these are untested. But I think for the industry as a whole, we work in an investment landscape where we've not seen inflation for 10 years. It involves a different way of looking at companies when you have inflation. You have to be, the scrutiny is in different areas, and certainly that applies to how you value the company as well. So it will require different techniques in the next few years. But at the moment, from a total view, we very much subscribe to the view that you want to own real assets in this type of environment. And a real asset can be anything from a digital telecommunications network to a pipeline or to a lithium producer. But the risks are on the inflationary side. The risks are most definitely on the potential for bond yields to rise after such a long period of deflation. And therefore, we have to be prepared and in a position to cope with the inflation environment that we see in the next 2 or 3 years.